Welcome to Real Estate Unfiltered, Singapore with Keith Tan. I'm Keith Tan, property advisor at ERA Realty Network, and this is where we cut through the noise and give you the honest insider read on Singapore property. No hype, no spin, just data, analysis, and real talk. Let's get into it.
What happens when property sales crash by like 40%, but the prices actually go up?
Yeah, it's a really strange situation we're in right now.
Right. Welcome to the Deep Dive. Today, we are opening up the latest data from Keith Tan's weekly market briefing, and we're unpacking a phenomenon that is honestly confusing a lot of people right now.
Oh, for sure. It's confusing everyone from first-time buyers to seasoned investors.
Because for years, keeping track of the Singapore property market has felt a bit like watching a runaway train. If you were a buyer, you were basically holding on for dear life.
Just watching prices blur past you.
Exactly. Just wondering if this thing was ever going to find the brakes. Well, according to the brand new Q1 2026 data, the train hasn't just found the brakes. It feels like it might be switching tracks entirely.
It really is a profound shift in momentum. I mean, we are looking at a market landscape today that is fundamentally different from the absolute frenzy we experienced back in 2022 and 2023.
Yeah, those years were wild.
They really were. And the underlying mechanics of how buyers and sellers are behaving have just completely changed.
And that is exactly our mission for you today. Consider this your essential survival guide to the current market.
Which you really need right now.
Yeah, whether you are a buyer hoping to finally catch a break, or, a seller lying awake wondering if you just missed the absolute peak of the market, or even if you're just someone trying to make sense of the headlines.
We are going to break down exactly how this works.
Right. We're going to figure out this massive staring contest currently happening between buyers and sellers, look into this frankly bizarre divergence happening in the rental market, and pinpoint exactly which segments of the island are completely ignoring the slowdown and still running red hot.
It is a lot to cover. And to really understand it, we have to look past the headline numbers and dig into the behavioral psychology that's driving these decisions.
Let's start with the shocker, because I was looking through Keith Tan's summary of the Q1 flash estimates, and the sheer drop in transaction volume is wild.
It's massive.
The market basically slammed on the brakes. But the paradox is prices didn't collapse.
Right. The data paints a very specific picture here. On the private home front, sales volumes plummeted by a staggering 40% compared to the previous quarter.
40%? That's huge.
It is. That is not a gentle cooling,
Yeah.
That is a hard stop. But as you pointed out, prices didn't fall.
They actually went up, didn't they?
Yeah, they inched up by 0.3% quarter on quarter,
right.
Which, is the slowest pace of growth we have seen in 6 quarters, but it is still growth.
Wow.
Meanwhile, in the public housing sector, HDB resale prices dipped for the very first time in 7 years.
Wait, I need to understand the mechanics here, because Basic Economics 101 says that if demand falls off a cliff, like if volumes are down 40%, someone out there has to be panicking.
You would think so, yeah.
Right. If nobody is buying, sellers should be slashing their prices to move their units. Why aren't prices falling off a cliff alongside the sales volumes?
That is the multi-million-dollar question, and really comes down to this massive island-wide standoff. We have a classic staring contest between buyers and sellers, and right now, nobody's blinking.
Nobody wants to be the first to cave.
Exactly. And to understand why, you have to look at the psychology of the buyer first. For the first time in a really long time, buyers actually have breathing room.
Meaning the fear of missing out is gone? Because I remember a few years ago, you'd go to a viewing and there were like 10 other couples there.
That was a nightmare.
Yeah, you felt like you had to write a check in the hallway or you'd lose the house.
And that psychology has entirely evaporated. Buyers are no longer in a rush because the supply side is it's finally catching up.
Oh, okay, so more units are coming online.
Right. If we look at the pipeline of completions, the number of ready-to-move-in units is rising from 5,200 in 2025 to an expected 7,000 units this year.
Oh, wow, that's a decent jump.
It is. And when you know there is a steady stream of fresh inventory hitting the market, urgency drops. You tour a property, you go get a coffee, you think about it for a week.
You actually negotiate.
Exactly, you negotiate. You don't just panic buy at the asking price anymore.
Okay, I follow the buyer logic. That makes total sense. But I'm going to push back on the seller side here.
Sure.
If buyers are taking their time and overall volumes are down that drastically, some sellers have to be feeling the squeeze. I mean, if your property has been sitting empty for months, why aren't you dropping the asking price to close the deal?
Because of a concept called price stickiness, which is heavily tied to the broader economy. Think of the current market like a game of musical chairs, except all the sellers brought their own comfortable armchairs.
Oh, I like that analogy.
Right. They don't care if the music stops because they already have a great place to sit. They have immense holding power.
So they aren't desperate.
Exactly. You generally only flash the price of a major asset like a home if you are under severe financial duress.
Like losing your job or not being able to make the mortgage payment.
Precisely. But look at the macroeconomic indicators for Singapore right now. Unemployment is hovering around a very low 2%.
Which is practically nothing.
Yeah. And, furthermore, real wages, meaning your pay after accounting for inflation, actually grew by 3.2% in 2024. That is the highest growth since 2019.
Oh, wow. So people are actually making more real money.
Yes. Household balance sheets are rock solid. So a seller looks at a lowball offer and says, no thanks. I can easily afford my monthly mortgage. I will just wait until someone pays what I want.
So people have stable jobs, their paychecks are keeping up with the cost of living, and there is no distress in the system forcing a fire sale.
That is the core of it. Propnex CEO Kelvin Fong is actually quoted in the sources describing this as a Goldilocks phase.
A Goldilocks phase. Okay.
Yeah, the market is not too hot, where prices are spiraling wildly out of control, but it's not too cold, where distressed sellers are crashing the market. It is balanced.
That makes sense.
Buyers are incredibly value conscious right now, pushing back hard on high per square foot valuations. But sellers aren't desperate enough to cave in to those demands.
A perfect stalemate. But, you know, buyers and sellers are just staring at each other, refusing to budge. Nobody is moving. Yet people still get married, they have kids, they relocate for work.
Right, life goes on.
Exactly. They need a roof over their heads today. If they can't buy, they are forced to rent. And looking at the rental data in Keith Tan's briefing, there are some really strange cross currents happening there.
The rental data is fascinating because it proves why you can't just glance at headline transaction numbers.
Yeah.
You really have to look at the structural forces underneath them.
Right, because I was looking at the January numbers and rental volume spiked across the board. Condos saw a big jump and HDB public housing rentals went up too.
Which usually suggests strong demand, yeah.
But the pricing did something totally counterintuitive. Even though both markets saw more activity, condo rents went up, while HDB rents actually went down. How does that make any sense?
Let's break it apart, starting with that spike in volume. That January surge is largely a seasonal illusion.
An illusion? How so?
It's the typical post-holiday corporate cycle. You get a fresh wave of expatriates relocating to Singapore at the start of the year, combined with administrative delays from December finally closing in January.
Oh, so it's just a backlog clearing out?
Exactly. It's a seasonal reset, not necessarily a massive structural boom in underlying demand.
Okay, that explains the volume, but it doesn't explain the price divergence. If I'm an expat coming in, why are private landlords able to charge me more while public housing landlords are dropping their rates?
This points to a massive structural event hitting the public housing market this year. We have to talk about the 2026 MOP wave.
Oh, right. And for listeners who might not track housing policy closely, MOP is the minimum occupation period.
Yes, exactly.
When you buy a subsidized build-to-order flat from the government, a BTO, you are legally locked in. You cannot sell it, and you cannot rent out the entire flat for 5 years.
And that 5-year mark is the magic number. In 2026, an estimated 13,484 of these HDB flats are hitting their MOP.
Wow. Over 13,000.
Yeah, and to put that in perspective, that is nearly double the number from the previous year.
Double. That is a staggering amount of supply hitting the market all at once. Imagine being a newlywed couple, you finally hit your 5-year mark, you decide to rent out your flat, and you suddenly realize half the people in your neighborhood are putting up for rent signs on the exact same weekend.
That is a perfect visualization of the supply shock. When you dump that much new inventory into specific HDB towns all at once, you fundamentally alter the power dynamic.
Because everyone's competing.
It intensifies competition among the landlords immensely. Suddenly, they are fighting over the exact same pool of tenants. And what happens when supply vastly outpaces demand?
Landlords lose their leverage. They have to drop the rent or throw in free Wi-Fi just to get a signature.
That is exactly what is driving the data. So the takeaway for you, if you are a tenant navigating the public housing market, is that your bargaining power has returned. In certain towns facing this MOP wave, the leverage has completely shifted back to the tenant. It signals that the public rental market is stabilizing long-term.
But the private condos aren't feeling this.
Right. The private condo market, on the other hand, doesn't have that artificial government-mandated supply shock hitting it all at once, which is why those landlords are still maintaining their pricing power.
It is wild how one specific government timeline, a 5-year lock-in, creates such a massive ripple effect across the entire economy half a decade later.
It really is.
So across the board, from the staring contest in sales to the supply shock in rentals, we're painting a picture of a cooling, stabilizing market. The heat is dissipating.
Broadly speaking, yes. The irrational exuberance is gone.
But, and this is a big but, if you look closely at the briefing, there are specific pockets of this market that completely missed the memo on the slowdown.
Oh, definitely.
They are absolutely defying gravity.
They are, and it highlights a very significant shift in buyer psychology. We are seeing a real change in what people value right now.
Yeah, I am talking specifically about the outside central region, the OCR, essentially the suburban heartlands. It feels like it is the undisputed star of the real estate show right now.
Without a doubt.
The briefing noted that over half of all condo resale transactions in January happened in the OCR, and the price growth is staggering. Since 2020, OCR prices have grown almost 48%.
Incredible growth.
Meanwhile, the core central region, the CCR, the prestigious downtown city center, only grew about 23%. The suburbs are completely dwarfing the city center. Why are people suddenly flocking to the heartlands?
It is a structural rejection of the old aspiration.
Right.
For decades, the ultimate goal for a Singaporean buyer was to move as close to the city center as possible.
Right. Everyone wanted District 9 or 10.
Exactly. A District 9 or 10 address in the CCR was the absolute pinnacle of success. But the pandemic fundamentally broke the economic premium of living near the central business district.
Because of hybrid work. I mean, if I only commute to the office 2 days a week, I don't need to pay a massive premium to live 10 minutes away from it.
That is a huge part of it. But it also ties into the concept of the 15-minute city.
Oh, right. Having everything you need close by.
Yeah. The heartlands in Singapore are incredibly well developed now. You have major malls, excellent schools, and comprehensive transport networks right there in the suburbs.
So you don't even need to go downtown.
Exactly. So affordability plays a role. The absolute price in the OCR is more manageable, but it's deeply rooted in a shift in values. Buyers today are prioritizing family-centric layouts.
They want more space.
They want more square footage. They need a dedicated study room for taking Zoom calls. They are actively choosing to trade the prestige of a downtown zip code for a larger, more functional home in the suburbs.
The daily utility of the space has become far more valuable than the prestige of the location.
Perfectly said.
And nothing captures that pursuit of suburban value quite like the executive condominium, the EC. The briefing highlights ECs as the ultimate sweet spot for these value-conscious buyers.
ECs bridge the gap perfectly. They are a unique hybrid in Singapore. They offer private condo facilities like pools and gyms, but they come with a subsidized entry price because they're initially governed by public housing rules.
Right, so you get the fancy pool without the insane mortgage.
Exactly. They cater exactly to that heartland upgrader demographic who wants the private lifestyle without the downtown price tag.
And there is a massive drought of them right now. There were only 2 ECs launched in all of 2025. But 2026 is like opening the floodgates.
Oh yeah, big time.
There are at least 5 EC launches planned, including huge ones like the 748-unit Coastal Cabana. Given the shift in values we just talked about, I imagine those show flats are going to be absolute madness.
The pent-up demand is immense. Given the pricing dynamics and the desire for suburban space, those ECs represent the exact value proposition that today's cautious, highly discerning buyer is looking for.
Now, I want to bring up one last surprising data point before we synthesize all of this, because it highlights just how fragmented this market really is.
Okay, let's hear it.
We talked about public housing resale volumes dropping and overall prices dipping. But in February 2026, amid all this cooling and caution, the market still recorded a $122 million flat transaction.
It is a remarkable figure for a supposedly cooling market.
Over 120 people paid over $1 million for public housing in a single month. That's insane. They made up over 7% of the entire month's transaction volume.
It's a huge chunk.
I look at it this way. It's like The VIP section of the club is still absolutely packed, popping champagne, even while the line outside the front door has completely disappeared.
That is a very accurate analogy. It proves that demand for a very specific type of asset remains essentially bulletproof.
Which type of asset exactly?
We are talking about premium, well-located, large-format flats, specifically 4-room and 5-room flats in mature estates. Buyers who have the cash on hand are still willing to pay top dollar for what they perceive as best-in-class assets, regardless of broader macroeconomic trends.
So even if the broader market cools, these specific units stay hot.
Right. It proves that we don't have one single property market. We have a market of micro segments.
So let's tie this all together. We've covered a huge amount of ground today unpacking Keith Tan's briefing.
We really have.
We've gone from a 40% volume crash and a buyer-seller staring contest to a massive rental supply shock, all the way to a suburban boom and million-dollar public flats. If you had to distill all this data down for the listener, what is the core reality of the 2026 market?
The core reality is that the market isn't crashing, it is maturing. The irrational exuberance and the sheer panic of the past few years are definitively over.
Finally.
They have been replaced by a highly disciplined, calculated market. Buyers finally have the time and the options to be choosy, and sellers have the financial strength and employment stability to hold their ground.
No more panic buying, no more fire sales.
Exactly. We have transitioned from a market driven by fear of missing out to a market functioning on economic fundamentals.
Which means, if you are navigating this market right now, your strategy needs a major update. The old playbook, the buy immediately before prices rise another 50 grand mentality, you have to throw that out the window.
Throw it completely out.
The new strategy is to negotiate smartly for value. You have the luxury of time. Do your homework. If you prioritize space for your family, the OCR offers better utility than the city center.
Definitely.
And if you are renting, look for towns hit by the MOP wave where you have the leverage to negotiate. The power dynamic has fundamentally shifted.
It has. But, before we wrap up, I want to leave you with one final provocative thought that the data points toward. Something that could completely disrupt the equilibrium we just spent the last 15 minutes discussing.
Okay, lay it on us. What's the wild card?
We discussed the massive 2026 MOP wave impacting the rental market, those 13,400 flats finishing their lock-in period. But remember, hitting MOP doesn't just mean the owners can rent them out.
It also means they can sell them.
Exactly. Estimates suggest that 5,000 to 6,000 of these newly unlocked units will likely change hands this year.
Right, owners deciding to cash out and take their pandemic-era capital gains.
Yes. And when those 5,000 to 6,000 owners sell, they are going to realize significant cash profits. That means thousands of newly cash-rich sellers will suddenly enter the market looking for their next home.
Oh, wow. Where does all that money go?
They become the upgraders targeting the private market.
So just as the market seems to be cooling down and everyone is locked in a staring contest, we are about to see a massive injection of upgrader cash hit the system.
Precisely. Will this sudden wave of liquidity kickstart a brand new cycle of demand, particularly in the suburban condo and EC markets? By the end of the year, it's a very real possibility.
Well, that's fascinating.
The staring contest might not last forever if thousands of newly funded buyers suddenly rush the table. Keep a very close eye on the heartlands.
What a thought to end on. Just when you think the runaway train is safely back in the station, you realize a whole new group of passengers is about to board. Thank you for joining us on this deep dive into Keith Tan's weekly briefing. Take this knowledge, apply it to your own situation, keep asking the hard questions, and most importantly, keep staying curious. We'll catch you next time.
That's a wrap for today. If you found this useful, share it with someone who's thinking about buying, selling, or investing in Singapore property right now. You can reach me directly on WhatsApp at +65 9750 1055 or find me on WeChat at keithtanbk. Visit keithtanbk.com for more market insights. I'm Keith Tan, and this is Real Estate Unfiltered Singapore. See you in the next one.